nggak nyala ya? Bisa? Baik, bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Welcome to the corporate finance class. So today we are going to start the lecture from chapter 14, talking about cost of capital. The objective of today's class is that you have the competencies of you understand how to determine the firm cost of equity capital. You know how to determine the firm's cost of debt. You know how to determine the firm overall cost of capital. And you understand the pitfall of overall cost of capital and how to manage them. So this is the competencies that is required that you have after the class. So let's start the class. So why cost of capital is important? You know, there is a jargon like this: the higher the risk, the higher wrong. The higher the risk, the higher the return. Yeah. I mean, so we know that the return earned on asset depend on the risk of those assets. So the return that the company have depend on the risk. The higher the risk, the higher the return. The lower the risk, the lower the return. Let's say you have money and then you want to put it in a bank into deposits. Deposit is low risk. Therefore, when you have deposit, you have low return. So far so good? Okay, understand? Okay, good. No issue, yeah? Talking in English, yeah? So we have an international friend here. So we talk in English. Yeah? If any question, also in English. Okay? No? In English, yeah? Okay, no worries. So the return to the investor is the same as the cost to the company. So let's say when you put your money in the bank, you put it in a depository. The return that you have, let's say you have return 5% per year, 6% per year, let's say. That also becoming the cost to the bank. You get it? Yeah? So the return that you have becoming the cost to the company. Or you put you invest your money in the company to make a company, and then the cost to you is the dividend. The company pay dividend. That is the cost to the company, but return to you. Araso? Wakaru? Wakarimasen? Oh, okay. Wakarimasen, eh? Okay. The cost of capital will provide us with the indication of how the market view the risk of our asset. Okay. Okay. Do you remember the cost of capital on chapter 13? Cost of equity, cost of equity, remember? Yeah. We have, in cost of capital, there is cost of equity and also cost of debt. Cost of equity, the expected return of cost of equity is risk-free plus beta times market risk minus risk-free. Remember? Okay. So this is cost of equity. Cost of debt is when people borrow money from the bank. The bank gives around 12% for the interest. That is the cost to the company. Yeah? So it will be cost of debt. Okay. The cost of capital is the cost of equity and cost of debt. If the company has 100% equity, meaning you use only cost of equity. If the company only borrow money from the bank, you use cost of debt. But if the money uses both equity and debt, you use what we call later on weighted average cost of capital. So the weighted average cost of the capital with the combination of cost of debt and cost of equity. So our cost of capital provide us with the indication of how the market view the risk of our asset. If you borrow the money, if you borrow from the debt and also equity, when we use both debt and equity, we talk about cost of capital, because you borrow money from the bank and you borrow money from the stock. When you have the IPO, you got money, then that is equity. But when also buying, borrow from the bank, that is debt. So far so good. Arasa, Wakaru, Khalas, jami'an, Khalas, Fahim, Wakaru. If you don't understand, say. And if you understand, Zenbu wakarimasu. You understand 100%. Zenbu wakarimasu. Only understand a little, sukoshi wakarimasu. If you don't understand at all, zen wakarimasen. Wakaru? Zen? Sukoshi? Sukoshi? Zenbu siapa Zenbu? Zenbu 100% understand. Zenbu wakarimasu. Zenbu kah? Sugoi. Alright. Silakan. Nyanyi dulu dan coba. So knowing our cost of capital can also help us determine. Yeah. Knowing our cost of capital can also help us determine our required return for the capital budgeting project. So, ini kayak baterai deh. Kita baterai dong. Minta ini. Mati dulu. Okay. So knowing our cost of capital So when you have the cost of capital using both debt and equity, you know the required return of the company. Yeah? If the return exceeds the required return, then it is undervalued. So go. If the return below the required return, then it is overvalued or inefficient. So the company is good to go with the project for the capital budgeting project, if only the return that the company will have exceed the required return. If it is below the required return, then the project, the capital budgeting, you should say, no good. Don't take the project because the return below the required return. So far so good. Arasto. Arasto? Zen dame? Wakarimasu ka? Sukoshi? Zenbu? Zenzen? Sukoshi. Good. Sukoshi is enough. So what is... So any question? Any question? So this is international class, yeah? So what? Any question? No question? All good? Any question? Okay. Zen wakarimasen? I don't understand what are you talking about. Talk in English, I don't understand you. I don't understand Indonesian. Okay, continue to the required return. I don't understand Indonesian language. Okay? Good. Next is required return. Required return is the same as the appropriate discount rate and is based on the risk of the cash flow. Okay. We need to know the required return of the investment before we compute the net present value of the project to make decision about whether or not to take the investment. We need to earn at least the required return to compensate our investor for the financing that they provide. So what is the explanation of this? So you have the required return. The required return, if you use only the equity, meaning this is the capital asset pricing model or expected return of the using the capital asset pricing model. Yeah. Remember the capital asset pricing model? The risk-free plus beta times market return minus risk-free. This is the expected return if you use the equity only. Okay? So, if the return of the company is the same, the return of the company is the same with the expected return or the required return, then the capital project you can do. Okay. So trade off the return the same. It is better off if the return of the company is exceeding the required return. Okay? Good. Very good. Yeah. Piece of cake, kan? Still introduction. Yeah. So, we talk about cost of capital. There is what we call cost of equity, just like I said before. Cost of equity. The cost of equity is the return required by the equity investor. The investor buy your stocks. The investor buy your stocks. So they are expecting return from you. Return from the stock price. So today's stock is, let's say January the stock price is 500. February stock price 600. March 650. So the return in February is 600 minus 500 divided by 500. 0.25. This is the return. 25% return. Going forward to March, April. So this one is minus 0.15 plus 0.10. So there is return, monthly return, coming from the closing price of the stocks. So the cost of equity is the return required by the equity investor, given the risk of the cash flow from the firm. At the end will be the annual return, let's say 0.23. So this is the return of the company. Yeah. You compare it with the capital asset pricing model. So the risk-free plus beta times market return minus risk-free. Let's say risk-free is 6%, 0.06, plus beta, let's say 1.2 times market return 0.1 minus 0.06. Let's say the return is 0.15. So the annual return is higher than the expected return from the capital asset pricing model. So do you take, so meaning that the company gives return more than the expected return, more than the required return. The required return is 15%, but the company gives you 23%. That is what we call, when talking about cost of equity. There are two major methods to determine the cost of equity. First is the capital asset pricing model. We talk about this in chapter 11. Remember? And there is second option using dividend growth model. Dividend growth model. There is also another method on top of the cost of equity problem. Any question? Any question? I cannot hear you. Question? Still refreshing the chapter 11. It's chapter 13. No worries. This is still chapter 13. Before we continue to the 14. All good? Wakaru? Sukosi? Zenbu? Zenzen? Sukosi. Good. Okay. So now we continue to the second method on the cost of equity using the dividend growth model approach. The formula is like this. This is the start of what is E0? Okay. So expected return in the dividend growth model is the dividend divided by the price plus the growth of the dividend. Yes. So let's see the example. Suppose your company is expected to pay dividend $1.5 next year. Okay. Let's say you buy stocks of Telkom, and then Telkom next year supposedly they will give dividend around $1.5. This is dividend 1, not dividend 0. Dividend 0 is dividend today. Dividend 0 is dividend next year. Yeah. So day 1 is dividend to be paid within a year from now, around $1.5 per share, per one stock. There has been a steady growth in dividends. So there is a steady growth in the dividend that paid by Telkom with the growth of 5.1% per year. 5.1% per year, around 0.05. Every year, the dividend grows at 0.051 a year, or 5.1% a year growth. That is what we call G, the growth of the dividend. The current stock price is $25. Yeah, the current stock price, $25. The question is, what is the cost of equity? The cost of equity is dividend to be paid next year divided by the price today plus the growth. So the dividend is 1.5 divided by the price of 25 plus the growth of 5.1%. Yeah. So how to estimate the growth rate? So we just noticed that the growth rate is 5.1%. How do you know that? The question will not give you the growth rate directly. You need to calculate the growth rate. The growth rate will be, let's say, year 25, 1.23, 26, 1.30. The percentage change will be 1.3 minus 1.23 divided by 1.23. So this is also 1.36 minus 1.30 divided by 1.30. This is 1.43 minus 1.36 divided by 1.36. 1.5 minus 1.43 divided by 1.43. So the dividend growth rate will be the average of this will be 0.051. So far so good to identify the growth rate. Wakaru? Wakaru? Sukosi? Zenzen? Zenbu. Good. Sukosi ya? Sukosi. Sukosi? Ah, sugoi. So, therefore, using the dividend growth model, we can also identify the expected return using the dividend growth model. Alright, that is the second option for the cost of equity. Okay, so what is advantages and disadvantages of dividend growth model? The advantages of the dividend growth model, it is easy to understand and use. Very easy. The price of dividend next year, the dividend to be paid next year divided by the price of the stock today plus the growth. That's all. The expected return. Yeah. Disadvantage is the model can only use to the companies that is paying dividends. If the company don't pay dividends, you cannot calculate the expected return. Alasan, so the company supposedly pay dividend on the yearly basis. If they don't pay, you cannot calculate the expected return. Got it? And also, it is not applicable if the dividend is not growing at a constant rate. This can be used to the constant rate dividend only. If it is 5.1, 5.3, 5.2, no, yeah, supposedly at a constant rate. And it is extremely sensitive to the estimated growth rate. If the growth rate changes, sensitively influence the expected return and does not explicitly consider the risk. So there is no risk involved because you don't calculate the market return, isn't it? If the capital asset pricing model, you must calculate the risk-free plus beta times the market return. So you also consider the market. So you consider the market risk as well. This don't care about market. So this is also the disadvantage if you use the dividend growth model. All good? All good? Understand? Good? Capish? Capish? Pronto. Mamma mia. So next is, this is the chapter 13, the SML approach, the CAPM approach. The CAPM is equal to risk-free plus beta times market return minus the risk-free. This is the same with the SML approach. What is the abbreviation of SML? Okay. So the question is now, risk-free is there. How do you know risk-free? What is the instrument you use to identify the risk-free? What is the instrument that you use? What? Deposito? No. What kind of instrument you use to identify the risk-free return? Either? No. Risk-free, you use the SUN, Surat Utang Negara, obligasi, bonds, but with the short period, not the long period, only with the 1 year period. The bond in 1 year period you consider risk-free. Why use government bonds? Not only the bonds, but James Bond. No, not James Bond. The government bond. The risk-free is government bonds. Obligasi pemerintah. We call it risk-free. Why? Why government bond is considered risk-free? Anybody can answer that? What? Why? Why government bonds considered risk-free? No, there is interest there. There is coupons. Yes. No. Why government bonds is called risk-free instrument? Okay, what else? You are right. Guaranteed by the government. What else? No risk. The question is why it is no risk? The government bond. Why is it no risk at all? Okay, but why? Okay, the answer is if the government don't pay, meaning the government is bankrupt. Yeah? Meaning Republic of Indonesia is bankrupt. Got it? So we call it risk-free. Because impossible, isn't it? Republic of Indonesia is impossible going bankrupt, isn't it? Are you sure? Are you sure? And then beta. And then market return. The market return is the Jakarta Stock Exchange. We talk about this in the chapter 11. The stock price of, the index price of the Jakarta Stock Exchange. January, February, March, April, May, June, July. And then the return. The index price of this month minus last month divided by last month. So we got the total annual return. So let me give you some, maybe some of you forget. This is the Jakarta Stock Exchange. This is Telkom. The Jakarta Stock Exchange, what is the price now? Around 5,000, 5,100, 5,250, 5,200, blah blah blah. This is month January, February, March, blah blah blah, until 12, 5,150. What is the return? 500 minus 5,000 divided by 5,000. Okay. Also happen to this. You got it here, and then in total is the market return, market risk. So this is, let's say, around 12% plus. This is what we call Jakarta Stock Exchange market return or return on market risk. Return is the same with the risk, isn't it? The return is the risk. And then what is the target price? Let's say 3,500, 3,250, 300, 300, and then what is the return? 3,250 minus 3,500 divided by 3,500 minus 0 blah blah blah. So you got it around 1.10. Let's say 1.10, 0.10. This is market return. This is the this is the market. This is the return of the company. Return of the company. The question is, what about the beta? How to determine the beta? The beta, we calculate it using the covariance. Covariance of the GE, General Electric. Let's say the company is GE. Yeah? The return of GE, General Electric, comma, market divided by the variance of the market. So we got the covariance of GE and market divided by the variance of the market. Let me give you example. So okay, we got here GE, General Electric, and Jakarta Stock Exchange. So what is the price? And between the price of GE, let's say from 3,000 until 4,000. Okay, this is the price of GE. Okay. What is the price of Jakarta Stock Exchange? Around 5,000. Until 6,000. This is the month. This is month 1, month 2, until 12. What is the return? Return on GE. Return on GE is the price of the GE stocks in month February minus month 1 divided by month 1. Forget not to give bracket here. Bracket 1, bracket 2. So this one is the return. What about the return on the market? The return on the market is the price of the index price of Jakarta Stock Exchange minus this one divided by this one. Okay? Pretty easy, isn't it? Okay, so you got the price here. Okay, so you have the annual return on the GE like this, and then you have the annual return of Jakarta Stock Exchange as the market return. This is the market return. This is the company return. The question is, how to determine the beta. Okay, beta is the covariance of GE and market. Wait a second. Divided by variance of market. Yes. Okay, we got beta here. So beta is the covariance. So let me put the formula text. Formula text. Yeah. Oh, formula text of here. Okay. Yeah. So beta is the covariance of the GE return and market return divided by the variance of the market return. So you got the beta. So far so good. Araso. Anybody eat machine today? No wonder. Okay. So this is how to calculate the beta. So when you have the beta, then you can put here. Risk-free is the government bonds with the period of 1 year is the risk-free. You can check what is the return of the bonds, government bonds right now. And then plus the beta. The beta is minus 0.12. Yeah, 0.12 times the market return. The market return is this one, the Jakarta Stock Exchange return, minus the risk-free. Risk-free is the government bonds. So you got the capital asset pricing model return. Okay, let's say we do it here. So, what is the capital asset pricing model or expected return is equal to risk-free. So let's say if you put risk-free is 0.05, let's say the 5% per year for the government bonds. The capital asset pricing model will be equal to the risk-free plus the beta, plus in the bracket of beta times market return is this one minus the risk-free. So this is the capital asset pricing model, the expected return towards the GE, General Electric. This is the expected return. My question is it okay to buy or not okay? If the capital asset pricing model is 0.15, if you want to decide, are you going to invest in the stocks? Are you going to invest or not? Yes or no? Invest or not? 17% capital asset pricing model. Are you going to invest or not? Yes or no? Huh? No. No. Yes or no? No. Why? No. I mean, if this is the model of GE, Loyola? No, why? We are talking about this. My question is no. Okay, no. Okay. Anybody yes? Who's yes? Sergio. Why do you put yes, Sergio? Sergio Ramos. Kayak nama beras sih. So why you put yes? Why? No idea? Don't eat my chin, please. Yeah? Okay. So the answer is yes, we buy this. Why? Because the expected return is lower than annual return. The company return is 22%. Sorry. No. Only 2%, yeah? Very small, yeah? Expected return is 17, yeah? So no good. No good. You don't buy these stocks. Because annual return only 2%. Expected return is 17%. No good. If the company return 22%, expected return 17%, you have 5% gaps profit. You can buy. This one, no buy. Araso. Cool. Sugoi ne. Sugoi? Good. Any question? Because this will be your first assignment. This is your first assignment for journals. I will separate into industry, and each industry there will be 5 or 10 companies. You calculate this. Huh? So one industry can be 10, can be 20. You calculate this, and then you select which company you buy. Okay. First assignment. Journal. Very good assignment, eh? Very good. Come, okay? No. Each industry can be 15, so can be 20, can be 5, depend on the not industry, sub-industry. Sub-industry, yeah. Not the total industry, but the sub-industry. Meaning, let's say bank, finance, there will be banking, insurance, maybe around 5, yeah, maybe 2. Okay, this is your first assignment. Good, because you all understand. Okay. Okay, first assignment release. Yes. Come again? I cannot understand Indonesian language. Yes? But I don't understand Indonesian language. The assignment is to conduct capital asset pricing model analysis toward specific sub-industries for your investment decision making. Yes, Loyola. Hire apa lower than market itu Pak? 17%. So the expected return 17%. Expected, yeah. The required return, expected return 17%. The company gives 2.2%. Very small. Sukosi ne. Sukosi. This is Thailand. Very big Thailand. Thailand ne. Thailand return ne. This one Sukosi return ne. dame ratio. Tidak bagus nih. Tidak bagus nih. Nah, it is bagus if the expected the annual return is higher than the expected return. Araso? Segai. Good. Okay. So this is individual assignment, ya. No group assignment. This is individual. Alright. Continue. So suppose this is example of capital asset pricing model. Suppose you calculate the beta. Yeah. Suppose the beta is 0.58. The covariance divided by the variance is 0.58. And the risk free is 6.1%. The government bonds 1 year. The expected market or the market return for the Jakarta Stock Exchange for 1 year is 8.6%. Jakarta Stock Exchange. Yeah? What is the cost of equity capital? If you only use the equity only, it is 6.1 as the risk free plus the beta times the market return minus the risk free equal to 11.1. This is the expected return using capital asset pricing model. So this you compare to the market, to the company return. If the company return more than 11.1, okay. If the company return below 11.1, it's dame. Dame ratio, dame des. Sugoi, araso, bakaru, kimochi. Nah, skepe deh, skepe, hentai ya, hentai. Abunai. Alright, what is the advantages and disadvantages? The advantages of using this, that it also adjusts with the systematic risk. There is systematic risk here using beta because we identify the beta, the return of the market. Yeah. Wait a second. What is behind this? Oh, okay, all good. Because I park my car down there, there is some people, what do you call it? If the car, yeah, so they tie your car and then they bring your car to the post, something like that. So I put it there. No worries. I just praying cameras down there. As usual, with you know who, yeah? The Mr. R.A. Yeah. You still watch my play, my game?
Yes, sir. I watch it every day. That's good.
Very good, yeah?
Hell yeah.
It's very Aguna, yeah? So, Raffi Ahmad is getting better now.
Oh my God.
Very good now, eh? Raffi Ahmad, eh? He play with me every day, man.
Oh my God.
Oh my God. Alright. Okay. The same. Now, so we continue to the cause of death. Cause of death. The cause of death is the required return on your company's debt. So, and there is a company. The option is using equity and using debt. There is a company using equity only. There is a company using equity only or debt only or combination of equity and debt. So we talk about using debt only. The company is using debt only, no equity at all. So what happened if the company using debt only? So the cost of debt is the required return on your company's debt. We usually focus on long-term debt or bonds. So when you need money, you need money, yeah? You need money. And then to get debt, what do you do? Number one, you need money. You want to borrow money. You need to borrow money. So what do you do? Go to the bank. Okay, number two.
Ask for sister.
Sister what?
Ask for sister or brother. Can I borrow money, bro?
My brother?
Brother.
Brother, okay.
Brother.
Yeah, okay. You borrow money from your family. What else? If you are a company, you need 100 billion rupiahs. 100 miliar. What do you do? IPO is equity. Raffi Ahmad said, this year he will go IPO. Trans Entertainment go IPO. Crazy, man.
That's crazy.
Oh my God.
Mind blowing.
So there is option for Raffi Ahmad. If he need money, there will be IPO. There is equity, cost of equity. But I suggest him to use debt. What do you do to get money from debt? You use long-term debt. What is long-term debt? Bonds. You issue bonds. Raffi Ahmad bonds. Rans bonds. James Rans bonds. Yeah? So Raffi will issue bonds. Or maybe IPO. I don't know. So if he want to use cost of debt, he want to issue bonds, James bonds. There is two methods to calculate the required return by using the yield to maturity. Method number one is using YTM, yield to maturity. Method number two, using bond ratings. Yeah. So we are going to talk about these methods. Suppose Raffi Ahmad want to issue bonds with outstanding 25 years. The bonds is planning for 25 years. So he will issue bonds 25 years to maturity. Mature. Raffi Ahmad offer coupon rate is 9%, meaning the interest rate. The coupon is the interest, around 9% per year. But Raffi plan to pay the coupon semi-annually, twice a year, every 6 months, paid interest, paid coupons. The bonds is currently selling for, oh, this is already, Raffi Ahmad already issuing, yeah. So the bond is currently selling for $908. Yeah. The present value is $908, while the future value of 25 years is $1,000. So when it is mature, Raffi will pay $1,000 bond per share, per page, yeah, per one bond, per one share bond. What is the cost of debt? The cost of debt, we can use this formula, or we can use the sulfur formula. N will be 50. Why 50? Because 25 years, semi-annual, meaning 50 times. Yeah? You pay coupon 50 times, interest 50 times. And then the payment, wait a second, the coupon is 9%, the face value is 1,000, price is 908, maturity 25, 50, coupon 9%. 9% with the rate. So the question is, what is the rate of the bonds? This is the question. How to tackle down this is using this one. Face value, so using the Excel, the face value is 1,000. Price is 908. Yeah. Maturity 25, 50. The coupon is 9% towards the price, 45. The rate will be rate of the H8, H9, H6, H7, and H6. So you got 5% rate. This is semi-annual, meaning for 1 year times 2. 5% times 2, year to maturity is 10%. So the required return is 10%. So far so good. Arasa? All good? Piece of cake, yeah? So you just put it in Excel. I already put it in the slide, yeah? Okay. So that is how to calculate the cost of debt using the yield to maturity. If Raffi Ahmad want to issue bonds. Questions? I cannot hear you. Are you okay? No? All good? Wakaru? Sukoshi? Zen wakarimasen? Zenbu wakarimasu. Loyola? Sukoshi, Zenbu, Zen. Sukoshi, all good. That's what Sukoshi is enough. Good. Alright. So next is the combination of using equity what we call it the weighted average cost of capital. A company may use equity only, may use debt only, and maybe both. Your company can use both, issue IPO and having bonds, both of them. So we need to calculate the required return, we use the weighted average cost of capital. We can use the capital in here. So we have, this is a combination of cost of debt plus cost of equity or capital asset pricing model. Okay. This, we can use the cost of capital that we have computed to get our average cost of capital for the firm. The average is the required return on the firm's asset, and the weight are determined on how much of each type of financing is used. Let's say this. Okay, this one. So, weighted average cost of capital is equal to the weight of equity times the expected return, the capital asset pricing model, plus the weight of debt times the cost of debt, the return on debt, times the 1 minus the corporate tax. Why we use corporate tax? Because in equity there is no tax. In debt there is tax. If you want to get money with no tax, go to equity, no tax. But if you get money from loans, from debt, all tax. All have tax. So, the weight of equity is the equity divided by the total volume times the capital asset pricing model plus the debt by the total volume times the debt rate times the 1 minus the corporate tax. Yeah. Example. Let's say Raffi Ahmad, my friend Raffi Ahmad. Guesty, yeah, guesty. You watch my game with him yet? Who watched my game with Raffi Ahmad playing tennis? Oh God, you guys already unsubscribe from my YouTube channel. Okay. So let's say Raffi Ahmad having equity and debt. Okay. Raffi Ahmad having the equity and debt. In equity, yeah, Raffi has 50 million shares, 50 juta shares, with the stock price of Rans Entertainment $80 per share, with the beta 1.15, with the market return Jakarta Stock Exchange 9%, risk-free government bonds 5%. Okay, this is Rans. The stock code is RAMS. Will be IPO this year, end of year. RAMS Entertainment was established around 3 years ago, 4 years. So yeah, for 3. they are already going to IPO this year. Crazy, isn't it? Crazy, man. He just buy a new car. The, what do you call it? The Black Ghost, Phantom? Rolls Royce, yes, Rolls Royce. Crazy, bro. 3 Rolls Royce in his house. Crazy. 3 Rolls Royce. And then Rans also has debt, issuing debt for the bonds. He has $1 billion. $1 billion, $1 million, ya. Within outstanding debt, bonds. With the current quote 1,100, with the coupon 9%, semi-annual, maturity 15 years, with the tax rate 40%. The question is, what is the required return for the Rans Entertainment? What is the required return? We use here the weighted average cost of capital. So what is the cost of equity? The capital asset pricing model is risk-free plus beta times the market return minus risk-free. Market return 9%, risk-free 5%. Yeah. Equal to, okay, this one is a little bit lost here. Supposedly 9 minus 5 times the beta here, okay. This is the 5 risk-free, equal to 15.35% expected return for the equity in Rans Entertainment. Crazy, man. And what is the cost of debt? Yeah. The cost of debt, you put 15 years, meaning semi-annual, and will be 13. Present value minus 1,100, the price currently minus. And then payment will be 45, future value 1,000. You got 3.9. Yeah. 3.9 semi-annual, meaning you have to times it with 2, you got 7.8. 3.9 times 2, because semi-annual, for semi-annual is 3.9, for annual will be 7.8%. This is the cost of debt. What is the after tax? So the cost of debt is 7.8 times 1 minus 0.4 equal 4.7. The cost of debt is around 4.7. Cost of equity is 15.35. Cost of debt 4.7. So, what are the capital structure weight? The equity is around 50 million share. Yeah. The stocks of Raffi Ahmad, we have 50 juta stocks times $80 per share, meaning 4 billion. 4 triliun kan? Besar ya. Sugoi nih 4 billion US dollar. Billion? Miliar ya, sorry. Million juta, billion miliar. 4 million dollar. 4 million dollar. For that 1 billion. Yep. 1 billion dollar times 1.10. The current quote is 1.10. Okay. Equal to 1.1 billion. In total, the volume is 5.1 billion. This is the portfolio of Raffi Ahmad. 5.1 billion US dollar. 5,1 miliar dolar. Very rich man. Supposedly he married again, yeah? With 4 wives. So, what is the weight of equity? Is 4 billion divided by 5.1. So 0.8, 78% of the portfolio is in equity, and for weight of debt is 1.1 divided by 5.1, meaning 21%. 21% is the weight of debt on Raffi Ahmad portfolio. So what is the weighted average cost of capital? Is the weight of equity times the cost of equity plus the weight of debt times the cost of debt. So we have 13.06, the weighted average cost of capital for Rans Entertainment. So if you want, you may buy Rans if only the return exceeds 13.06%. The return. So you have 15% return? Okay. The expected return is 13.06 per year. Capish? Pronto. Abunai or Raffi Ahmad? Abunai. Very good. So he buy football league in Bali. He make basketball team. Yeah? And also tennis team. If you watch Raffi with Rifki Fitriadi, number 1 Indonesia tennis player, playing with me? No, nine. Okay, I will send you later. Any questions on weighted average cost of capital? Which one do you prefer for the assignment? The weighted average or the CAPM only? CAPM only, yeah? Okay, deal? Okay, good. So, using weighted average cost of capital for the project, what would happen if we use the weighted average cost of capital for all projects, regardless of the risk? Assume that the WACC is 15%. So, the required return, if the weighted average is 15%, meaning the required return is 15%, and the internal rate of return is 18%. We accept the project if only the internal rate of return. This is chapter 10, yeah? No. Chapter 10, yeah? We talk about internal rate of return, yeah? If only the internal rate of return is higher than weighted average cost of capital. Yeah? So, there is project. So, what is the cash flow of the project? The cash flow is for year 1, year 2, year 3, year 4, year 5. What is the cash flow? Let's say 500, 300, 1,000, 700, 500. And then what is the rate? The present value. Yeah, let's say the present value is using the 5%. So you calculate, okay, around 300, 200, Present value totally. Sorry. This is the net present value. Yeah? This is the net present value, the NPV. And then using that NPV, you identify the internal rate of return. If the internal rate of return that you got from the NPV higher than weighted average cost of capital, the project, okay. If the internal rate of return below the weighted average cost of capital, the project is damage. Good. So that is the topic for today. Applause dulu. So we are going to use English from now until forever. All good? Sugoi? Sugoi? Sugoi, dami? Sugoi? Who sugoi? Sugoi. Who put sugoi? Who dami? Dami. Naze yo. Naze. Kenapa ya? Naze. Muzukasi kah? Muzukasi ini susah kan? No worries. The video will be 2. The video for the class will be 2. The English version and Indonesian version. The Indonesian version is there on already. So if I use Indonesian language, no need to record ya. There is already record. English language, very good. Okay. So next week we all also talking. Or you can request. We talk in Spain, Hindi, Arabic, Japanese, Korean, Russian. Okay. Sip. Okay. So, any question? Mondai? How to find the surat utang negara rate? Go to the Central Bank website. Yeah, Central Bank website. So, guys, you already has your assignment for capital asset pricing model. Individual, I will assign the sub-industry for each one of you. So nobody can, so the method is the same, but the company will be different for all of you. Okay? Samina, all good ya? Understand the whole class ya?